Our market monitor tonight has a few stocks he says will hold up in both good times and bad times in the stock market. That sounds like a pretty good recipe tonight. He's Jim Awad, chairman of Plimsoll Mark Capital. Mr. Awad, always good to see you.
My pleasure.
I see that you say you're leaning towards large conservative stocks with low investor expectations. Trouble is, sometimes these kinds of stocks live down to those expectations.
Well, that's the key. You've got to be right on the fundamentals. But I think it's very important in this environment to sort of lower your risk profile, given the fact that we're at a point where the market could go either way. So, yes, you're right. Sometimes they just keep going down. But in these three cases, I don't think that's going to be the case.
All right, well, let's talk about them, Jim. You have IBM at the top of your list, and this is a stock that's very controversial. Investors have been so frustrated. The stock just has been going up and down and all over the place. Why are you recommending it now?
Well, it's misperceived. It's viewed as an old line company that the world has passed by, and the bad rap is that its revenues have not been growing the last few quarters. Yet if you really drill down on it, first of all, it's at a PE ratio just a little over half of that of the stock market. It's got a dividend yield of 2.5%. Their record over the last 10 years has been to grow operating earnings at about 12% and increase the dividend at a rate of about 13%. And they are buying back stock, increasing margins, and they're rapidly transitioning to the cloud and the new business lines. In fact, their cloud business has doubled since the end of 2012. So I think you're in a situation where you'll start to see the revenues accelerate along with the earnings.
So when you see those kinds of numbers that you just described, it's got to be misperception there, because if you're growing earnings and you're growing the dividend, you ought to see some payoff for that. Let's move to another one that has really been becalmed over the past decade, and that's General Electric.
Yeah, now there's a stock that's down 9% this year versus a 4% increase in the S&P. And I think it's just misunderstood because it's very complicated, and they've been going through a series of restructurings, and people haven't taken the time to understand what they're doing. They are moving to the higher margin part of their business, which is the industrial side, de-emphasizing the consumer and the financial side. And again, here's a company that's been growing organically, revenues at about 6%, increasing margins so that operating earnings are growing at 8%. Plus, you get a 3.5% dividend, and they're buying back the stock. Disciplined financial management, and so and it's selling at a PE ratio of about 13 times versus 16 times for the market. So it's growing operating earnings faster than the S&P, and its PE ratio is lower, and its dividend is higher.
Okay, let's round it out with J.P. Morgan. CEO Jamie Dimon back at work after his cancer diagnosis. Tell us what's going on, your outlook for this company.
Okay, so the wrap on this company in the industry is that the government has regulated them so much and constrained them so much as a result of the financial crisis that they're basically no growth and just utilities. Yet if you look at J.P. Morgan, obviously the best management, or among the best management in the industry, a fortress balance sheet. Loans are starting to grow as the economy improves. Legal expenses are declining. And again, you're going to have a situation where margins are going up, and they're buying back stock and dividends at the rate of $3 billion a quarter.
Jim,
the real value.
Jim, it's great to see you as always. Thanks for joining us tonight. Jim Awad with Plimsoll Mark Capital.